This video is going to show how to depreciate a long-term asset and then how to sell it for a gain or a loss. I've drawn out some T accounts so we can see how these transactions affect the general ledger accounts. So I made a T account for equipment, accumulated depreciation, equipment, depreciation expense, gain, loss, and cash. Let's briefly talk about what each of these accounts are. Equipment is an asset and so is cash, so they're going to go up with a debit and down with a credit. Accumulated depreciation is a contra asset, so it will work the opposite way. It will go up with a credit and it will go down with the debit. Depreciation expense is an expense, so it goes up with a debit and down with a credit. Gain or loss is going to be on the income statement, so it can be seen as either like a revenue or an expense. A gain would work like a revenue, so it would go up with a credit. Loss would work like an expense, so it would go up with a debit. Gains and losses are found under operating income. If it's a gain, it will be added to operating income. If it's a loss, it will be subtracted from operating income to get down to your net income. Now, the reason it goes down here in operating income is because a company does not normally sell assets in normal business operations, so it does not fall under your revenues or your expenses. Okay, so let's say we purchased a tractor for $500,000. On the day that we purchase this tractor, we will debit equipment for $500,000. And we would credit cash for that if we paid cash for it. Change to the financial statements on that day would be that cash would go down by $500,000 and equipment would go up by $500,000. So basically we traded an asset for an asset, so nothing really changed, and that's why it doesn't affect the income statement. This can be confusing for students because we spent $500,000 of cash, so why does that not affect the income statement? Well, we purchased equipment, an asset that we have not used up yet, so there's nothing to show on the income statement. It is sitting there, it hasn't been used to generate revenue, so it has not affected the income statement yet. At the end of that year, we're going to depreciate the equipment. So some companies do it monthly, some companies do it yearly. For this problem, we're going to depreciate it each year. So if we were to do this by straight line depreciation, we would have a depreciation each year of $100,000. So we would debit depreciation expense and credit accumulated depreciation for $100,000. So now we have depreciation expense on our income statement for $100,000. So that will reduce your net income by $100,000, and it would be an operating expense. So we would put the accumulated depreciation balance just below equipment on the balance sheet to show that $500,000 minus $100,000 would give us our book value of $400,000. We would continue like this for 5 years. So each year we would debit depreciation expense, credit accumulated depreciation, to record depreciation. Of course, depreciation expense, remember, is an account we close each year, so it actually would start over each year. So in any given year, your net income would be reduced by the $100,000 because that account closes at the end of each year. However, accumulated depreciation is a permanent account, so it's going to continue to go up At the end of the second year, it'd be $200,000. At the end of year 5, it would actually be $500,000. So since at the end of year 5, your accumulated depreciation would have a balance of $500,000. Your book value would be $500,000 minus $500,000. Your book value would be 0. You would call that fully depreciated. Now, you're still using that tractor. It's still good for you. So we need to show on the financial statements that we're using it. However, there will be no depreciation expense for that tractor after year 5. Now, let's say that we decided to sell the tractor in year 7. Now, let's say we got cash for $25,000. We would debit cash for $25,000. When we sell an asset, we have to get rid of the accumulated depreciation. How much is in the accumulated depreciation account? Well, it has a $500,000 credit balance. So to get rid of it, we would need to debit it for $500,000. Because once you sell the asset, you no longer need the accumulated depreciation account for that equipment. You need to wipe it off the books. So let's get this account down to 0. Okay, so now your equipment, so you're selling it, so you need to get rid of it also. So you're going to credit it for $500,000. Now, you need your equipment off of the balance sheet because you're selling it and it will no longer be there. So to show that it's sold and it's no longer there, that's why you credit your equipment for $500,000, and now it has a balance of 0. And accumulated depreciation of that equipment has a balance of 0. It's gone. It's sold. So at this point, you can calculate your gain by seeing what you need in your journal entry for it to balance. Your total debits are $525,000. Your total credits are $500,000. So it looks like you need a $25,000 credit for your journal entry to balance. If it's a credit, it's a gain. If you would have needed a debit for your journal entry to balance, it would be called a loss. And this gain would be over here on the income statement, which would be added to get to net income. So that is how you calculate a gain or a loss on fully depreciated equipment or a fully depreciated fixed asset. Now let's say we sold the equipment after year 3. Okay, so I need to back up and I need to delete everything after year 3. So at this point, accumulated depreciation would have a balance of $300,000. Say that we still got $25,000, but now how much accumulated depreciation needs to go away? Well, we have a credit balance of $300,000, so we would need to debit it for $300,000 to make it have that 0 balance. So accumulated depreciation has been wiped out. Okay, so what's your equipment cost? Well, we still need to make the full amount of the cost go away. So that's going to really just stay the same. We would credit it for $500,000. So it has a 0 balance. It's been wiped out. All right, now what would you need in order for it to balance? You've got $325,000 on this side, and you have $500,000 on this side. Okay, so you would have $500,000 minus the $325,000. So you would need 175,000 on the debit side. So this would be a loss instead of a gain. So it doesn't matter if you're fully depreciated or somewhat depreciated, you always need to get rid of that assets account, the accumulated depreciation and the cost of the asset. Once you get the balance of those two accounts to zero and account for the cash that you received. Now, if you didn't receive any cash, that would be zero and that would be fine. At the end, the difference in debits and credits will give you either a gain or a loss. If it's a debit, it will give you a loss. If it's a credit, it will give you a gain. That is how you calculate gains and losses on the sale of depreciable assets.